Hello everyone, this is Dwayne here from Malaysia, trying to help you improve your financial situation. Today we are going to discuss a topic in which I call the diversification of risks. In essence, what diversification is not putting all your eggs in one basket and spreading out the risk across several different vehicles to earn you money. Alright, if you've watched my previous video, you would know that I highly suggest that you open an EFD account. Okay, an electronic fixed deposit. Now, EFDs are protected by PIDM, which means that if your balance does not exceed 250,000, even if the bank goes bankrupt, you are not going to lose your money. The government will pay you back the money, even though it might take some time. In either case, now you have two different accounts. One is your investment account, the other side is your EFD account. Now you need to balance both of this. Okay, how are you going to do this? You can actually use a ratio depending on your risk tolerance. All right, now a 2-to-1 ratio is quite a good ratio in my opinion. All right, so in other words, you should have always double the amount of money in your EFD account as opposed to your investment account. Now, why is this? It's because first of all, you're looking for about a 6 to 7% dividend return on your stock portfolio, whereas you're only looking at about a 3% return on your EFD account. So for example, if you have $10,000 inside your EFD account, you should get about a 300 ringgit return per year. But if you were to have 5,000 ringgits in your investment account, you're only looking at also about a 300 ringgit return. Therefore, it is balanced. All right. So the higher the return, the less money you should put inside. All right. The reason for this is very simple, because higher returns normally is associated with higher risks. All right. So you're going to spread your risk out across these two vehicles in the first place. All right. Your amount of money in your FD account will always be safe as long as you do not exceed this amount per bank. Now, as we go into your stock portfolio, there are many things that we can actually do. For example, invest in REITs, invest in individual stocks such as Maybank or Matrix, or any other stocks that you feel comfortable investing your money in. Okay, like I said, the higher the return, the less money should go inside that portfolio or that stock. So why is this? It's because you do not need as much money in order to make the same amount of return. What we are looking for is to steadily grow our wealth over time. We do not want to lose money. Nobody does. If you were to put your money in the stock market and only in the stock market, when the recession hits, which it will one day, you're going to feel as if you lose all your money overnight, although it's just a paper loss. If you have picked your companies properly, you would know that eventually it will recover, right? But you are not able to do much during the recession. Now, when you balance it like this, okay, you're still earning money from your fixed deposit account. And hopefully you will be earning money from dividends from the stocks that you have bought. Okay? When you have money coming in every quarter or every month like this, what happens during a recession is you are able to buy more. All right? Providing that the stocks that you pick are stable, they will last over 50 years, you will be able to buy companies' stock at a huge discount, albeit not much. All right, so for example, right, if we take today's day and age, you have $10,000 in your fixed deposit, and say a REIT like ARREIT is worth only 76 cents as of today. You are actually able to buy just a little bit over 400 units at this point. Say for example during the recession, whereby business is bad and people do not think that the stock is worth as much as the stock market price now, and it drops to about 35 cents. Essentially, you are able to use your EFD interest in a year in order to buy 800 units instead. Now, the beauty about EFD is that you are able to get your money on the spot, right? I'm not saying take out your EFD, but use the interest in order to buy into the stock. This is why you want your balance to keep increasing month after month. What you can do is take the interest every month and transfer into your investment account. As your balance go up, you would have more and more money every month in order to invest in the stock market. So for example, if you were to have 10,000 ringgits inside your investment account, you would have roughly about 24 ringgits in order to invest every month. And this does not seem like much, but if you transfer it every month, this month you're going to have 24 ringgits, next month you might have 26, next month you might have 28, and it adds up. Eventually you're going to be able to reach the point where you are able to invest over 50 or 100 ringgits a month. This is a very good place to start. Alright? So as you transfer your money into the investment account, you're going to buy stocks which are relatively cheap or within your buy range at least. If you cannot, then you're just going to stockpile the money until it reaches the point where you can buy 100, 200 or 300 units, up to you. This is what I call the synergy between investments. Alright, you are going to actually use your EFD in order to get the interest to buy stocks. As the stock price go down, you might feel a little disheartened when you see the value of your stocks going down, but in all honesty, it is just a paper loss. You do not lose any money until you sell. Most of the stocks you buy should be able to pay you dividends even throughout the recession. If it doesn't, then perhaps you should be looking at picking different stocks which do. More stable stocks which are able to pay dividends even though the recession has hit. This is what we call dollar cost averaging. Alright? So the interest will be able to buy more and more during the recession because nobody knows when the market is going to bottom out. Just like when nobody can actually predict the peak, nobody can actually predict the bottom. So by having a stable vehicle to constantly supply you with money, you are able to buy equity in different companies that pay dividend at a cheaper price. Most of the time, the dividends do not drop even though the stock price drops during the recession. So what that means is that when the stock market recovers, you would have a certain portion of investments that have bought on the way down to the bottom of the market. And as it starts going back up, you're still buying with the interest. Therefore, what's going to happen is that the ones that you bought at the bottom, you will make a significant amount of money when the market recovers. Of course, this is still a paper gain. If you were to be able to track how much you bought during the recession, you can sell those off at a profit and look for other vehicles in order to invest in. Personally, I do not see the need for this, as all stocks I own, I feel that I would want to hold it for at least the next 50 years. I'm more interested in getting the dividends from the stocks as opposed to selling off for a huge lump of money. Now, this could be a bit different if the stock market quadruples in price, in which then I would just sell it off and find a different company to invest in. But this is unlikely to happen unless you are actually investing in a very risky stock. Most of your investments should be stable, giving you a 5 to 7% return. Do not ever chase the dragon. In Chinese, we have a saying for gamblers in which that they all want to chase the dragon. You always want to chase the jackpot. No matter how much you win, you want to win more. Do not do this. Just invest slowly and grow your EFD account. Use the interest in order to invest in the stock market. When you actually get your balance high enough, then you can transfer some funds to your investment account. But other than this, you should not ever put more money in your stock account than in your EFD. Thank you. I hope you found this information useful.